Welcome to the Road to PPP Loan Forgiveness and Payroll Tax Relief under the CARES Act, sponsored by the ABA section of Taxation. Moderating the program today is Allie Petrova. Allie is a managing attorney with Petrova Law, PLLC, and is the chair of the Closely Held Business Committee of the ABA section of Taxation. She is located in Greensboro, North Carolina. Allie, please proceed with today's program.
Thank you so much. Hi, I'm Allie Petrova. Welcome, everyone, to today's program. I'd like to introduce the rest of today's panel. It's my pleasure to introduce my four colleagues who are all accomplished attorneys in the private sector and are with well-regarded law firms across the country. Ivan Golden, Robb Longman, Noelle Geiger, and Jonathan Zimmerman. Ivan is a partner in the Chicago office of Hahn, Loeser, and Parks. Ivan helps clients with corporate and tax planning and tax dispute resolution. Robb is a managing member with Longman and Van Grack in Bethesda, Maryland. Noelle is a partner with Green and Sklarz in New Haven, Connecticut. Jonathan is a partner with Morgan Lewis in Washington, D.C. If you'd like, you can read their bios online and learn more about them. I'd like to thank the American Bar Association for having us on this program and our speakers for taking the time to present today. I'd like to remind everyone in the audience to respond to the verification alert throughout the program to verify your attendance for CLE credit. That's very important if you'd like to receive CLE credit. Let's move forward to the substance. Today, we'll cover the loan forgiveness aspects, the Paycheck Protection Program, and payroll tax stimulus measures included in the CARES Act package. With demand exhausting the first round of funding rather quickly, Congress approved a second round of funding that is now being distributed. We're going to focus on 6 main areas today. We're going to talk about the loan forgiveness requirements and use of proceeds to maximize the amounts forgiven. We're also going to talk about avoiding pitfalls in remediation, and we're going to cover the application process and stimulus options for businesses that do not participate in the program, like the Employee Retention Credit and the Social Security tax deferral. Please note that the Internal Revenue Service issued guidance right at the end of last week. And this topic that we're covering today is an evolving area. And now with this background, I'd like to turn the program over to Robb.
Great. Thank you very much, Allie. So we're going to kind of start off with a background regarding the Paycheck Protection Program. And as Allie said, I feel like it's almost every single day or every single night at least, and maybe sometimes a couple of times throughout the day, that I keep getting email alerts, whether it's from the IRS or the SBA, regarding changes to this program and new notifications. So please understand that everything here is obviously it's a fluid, ongoing situation. So we are giving you as best information that we can and as most up to date as we have been provided. So the CARES Act background. The Coronavirus Aid, Relief, and Economic Security Act, the CARES Act, became effective March 27, 2020. It's for businesses and businesses started to apply for this act, the PPP, on these loans starting April 3rd, 2020. So roughly about 1 week afterwards, a little bit more. And those were just businesses with employees. Individuals who were just self-employed individuals were allowed to begin applying for the PPP loans beginning April 10th, 1 week after smaller businesses and other businesses were allowed to apply. SBA announced on April 16th, just about 2 weeks afterwards, that the initial $349 billion that was appropriated had been totally exhausted and used, and had been approved for other loans. On April 23rd, 2020, Congress appropriated an additional $310 billion, with $60 billion set aside for lending to community banks and credit unions. So right now we're kind of still in that foresight of seeing what loans are going to be approved based upon that second $310 billion. In addition, I'm sure as many have seen in the news where certain businesses did take those loans, and then returned those funds. So those monies will most likely become, and hopefully have become available again as part of that initial approval that was appropriated. So what do you have to do to qualify for a PPP loan and for the loan forgiveness? So the Paycheck Protection Program, it's loans to businesses, and the businesses are, in most cases, 500 employees or less, and is providing an amount of funds that's going to cover an 8-week period for those businesses applying. PPP loans may be used for any of these following expenses: wages, commissions, and other income of employees. And coming into these definitions for wages and other employees, we are also looking at self-employed individuals here, whether or not they're necessarily receiving wages as we typically look at it in the sense of a W-2, but at least to cover portions of their income as well. And that's one of the things that is typically different with regards to these PPP loans as opposed to what you typically see coming out of the SBA. It will cover vacation, parental, family, medical, and sick leave. And there are certain exclusions with regards to the family, medical, and sick leave, which we'll discuss in a little bit, because it's not going to be all family, medical, and sick leave. It can be used to cover payments of the group health care benefits, including insurance premiums, and the payment of retirement benefits, the employer share, not the employee share. It can be used for the payment of state and local taxes, and for self-employed individuals, income replacement based upon the 2019 net profits not to exceed $100,000 prorated for the covered period. And I'll check to my other panelists to see if anybody wants to jump on with anything here on what else it's allowed to be covering.
Rob, this is Ivan Golden. We'll get into some of this in more detail, I think, a bit later. But one of the things that's interesting to note here is that you can cover wages, commissions, and other income of employees and so forth for that 8-week period. However, it's all prorated up to $100,000. So what that means effectively is that you can't pay an individual employee more than $15,385 during that 8-week covered period. To the extent you do, it will not qualify for loan forgiveness, and I don't believe is even a qualified use of the funds. So, one of the things that I think is sort of a best practice, although perhaps not strictly required, is to segregate the funds into a separate account. And to the extent you're paying an employee more than that amount during this 8-week period, you might consider even having, different checks cut or different, the payroll coming from different sources, because obviously you don't want to have the funds, commingled in such a way that it's difficult for your lender or for the SBA to determine whether all the funds were in fact spent for qualified expenses.
Yeah, so you'll see that as the top exclusion we have there for employees in excess of $100,000. So, one of the things you want to ensure is when you have clients who are applying for these loans, because that amount over that $100,000 is not going to be excluded, that when you come up with your compensation, and we'll get to the equation for how to determine how much you are allowed to apply for, you're going to be excluding those amounts over that $100,000, as Ivan had stated. The funds can also not be used for an employer's share of federal payroll taxes, so the Social Security and Medicare. That's still going to be falling upon the employer to pay out of the employer's pocket. Compensation of employees whose principal place of residence is outside of the United States. And then prior to the PPP coming into effect, we had the Families First Coronavirus Response Act. So this act basically required qualified sick leave and an extension of the FMLA for individuals who are sick or sick and caring for somebody who has the coronavirus. And when I say sick, I mean sick with the coronavirus. Or if they were unable to work at that time because of children being home due to issues of the coronavirus, which probably is anybody who would have kids in just about, I think, about almost any public school or any school system for now. As far as I know, most of them are still closed. But that is the situation. So if they were home for those purposes and that's what they were on sick leave for, then or FMLA for, then it was not supposed to be used for those funds. So who is going to be eligible for the PPP loan? Just about all businesses were eligible for the PPP loans, and I think we really saw that. And one of the reasons that it became so open is that numerous restrictions that are usually required with regards to SBA loans were not in place at that time with regards to the PPP loan. So have to have less than 500 employees. This is full-time, part-time, or any other type of basis. It's calculated pursuant to an SBA or calculated pursuant to the SBA regulations as to what will be defined as a small business. And based upon that is why we...
If I could just interrupt, one interesting thing to note here, and I actually had this situation come up for a client the other day, is there are many businesses in industries that have been, particularly hard hit by COVID-19, where their number of employees may have declined very dramatically with furloughs and so forth. I know of businesses personally that have gone down from over 1,000 employees to maybe a couple of hundred. And questions come up a couple of times as to whether or not, well, if we have a couple of hundred employees today, are we eligible for a loan because we're under 500? And I think initially it's a bit difficult to answer that question because the loan application itself, and even the statute for that matter, says 500 employees. However, the SBA's position is that you measure that according to the usual SBA rules, which generally speaking say that you look back a year and you calculate the average number of employees during either the preceding 12 months or for last year. So if you represent a business that had 1,000 employees on average last year, now because of these awful economic circumstances, they're down to a couple hundred. Unfortunately, they're almost certainly not going to be eligible.
Yes. So I mean, and as Ivan's indicating here, the act itself had very specific rules in it, but to some degree they were also open with regards to SBA regulations, where it makes certain reference back to the SBA regulations. So it gives SBA a little bit more leeway with regards to their assessments on those numbers as well. So we have applicable number of employees as determined by the SBA is kind of what Ivan was referring to based upon the type of business that's being employed or that's applying. And then businesses in certain industries are ineligible: life insurance, financial businesses, businesses without payroll, private clubs, and certain SIN businesses. The inclusion of sole proprietors and independent contractors and other self-employed individuals is something that's different typically for the SBA with regards to cumbering their funds. You are and those individuals have to submit income and expense information as required by the expenses and as required by the SBA. And this is also something that's important to remember is if you have clients or if you have independent contractors or other sole proprietors who you pay on a regular basis, they are not to be considered in the payroll application when you are applying for the loan, because they would have to apply for their own loan since they are sole proprietors or independent contractors. It would only be employees or other individuals who are similar to the employees but not independent contractors that the business is paying. Businesses that have more than one location can apply if they have an NAICS code beginning with the number 72, which is accommodations and food services. They have not more than 500 employees at one location. And I think we all saw the result of what happened with some of the larger restaurants who fell into those categories. Waived affiliation rules and the NAICS codes, and then businesses operating as a franchise that are assigned a franchise identifier by the SBA. Borrower requirements. So the borrower shall make good faith certification that, among other things, the current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. And this is something, my colleagues and I were kind of discussing prior to, is that the current economic uncertainty makes the loan request necessary. So it's kind of a general statement that, you have to look at the finances of the business. If certain businesses are able to continue to operate during this time, so for example, let's take a law firm for that matter. Most law firms are still open in the sense that their employees are working. We will assume that they are generating income in the sense of at least being able to bill out to their clients. The question then becomes is whether or not they're collecting on those funds. But they will then, hopefully after all this is over, be able to collect on those funds if the clients come back and say, hey, we can't pay you during this time. Well, are some law firms then stopping the work that they're doing? So the real question becomes is with those businesses is, whether or not this loan is going to be necessary to support ongoing operations. You have certain medical practices where the number of patients that they're seeing has decreased. So in those situations, we're looking at those businesses where even though they may be operating on a smaller scale, they still have the same payroll that they had before. So there they have to, are they getting those loans to keep their operations going?
Rob, I think one of the things that is really interesting about kind of what the sort of ebb and flow of this is that, there's a couple of requirements right in the statute. One is this certification. This certification language is actually in the statute, and it says that, borrowers are required to certify that current economic uncertainty makes this loan request necessary to support, not to fund or it's not sort of a but for this we will go out of business, but just to support the ongoing operations of the business. And I think based upon that language, almost every business, whether it was still operating or not, almost every business felt that they could in good faith make that certification. Maybe the only exceptions would be those rare businesses like grocery stores or businesses that were actually helped by this. But, virtually every business felt they could make that certification, I think, in good faith. What we've seen, however, is now, the first round funding was completed, and it was obviously a finite amount. There was a total, frenzy of businesses applying. And instead of the funds going exclusively to small and medium-sized businesses, we see a lot of the funds going to, some publicly traded companies, some private equity-backed companies, some very prominent companies like the Los Angeles Lakers that are, owned by, multimillionaires and billionaires. And I think to a certain extent, and this is just sort of my opinion, so take it for what it's worth, but I think to a certain extent, there's a thought of, well, there may be some embarrassment even on the part of the Treasury and the SBA, and they're now trying to backtrack and say, well, wait a second, you're not eligible if you have that kind of access to cash or access to credit. But there is no such requirement in the statute, and in fact, it's the opposite, because the statute specifically says you are not required to certify that you can't get access to credit otherwise.
Right. So now, Ivan, this is Noelle. How do you feel about the frequently asked question 31 that was put forth by the SBA recently, outlining 2 subjective tests which would ask the borrower to certify that they couldn't maintain a current level of business activity, and their ability, questions the ability to assess other sources of funding. So that these sort of new and uncertain and subjective terms are really stirring up uncertainty now with regard to how we defined available other sources of liquidity. And for example, should someone have to, some solo practitioner have to tap into their retirement before being eligible for this program? And I read something, I think it was this morning, that the Justice Department has already contacted 15 of the 20 largest loan processors because they intend on investigating how people certify that they were, whether they were really eligible. And we will see the most egregious subjected to not only penalties, but maybe prosecutions for mail and wire fraud. But like you said, I agree with you, the statute, when it first came out, and I read it, it was check, 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 I'm eligible, I'm going to fill out the application, why not? And then this wave of scrutiny came out, and then this frequently asked question issued by the SBA just really muddies the water.
Right. And I still think that, for the vast majority of businesses that are applying for these loans that don't have, an owner that is a private equity fund or a, billionaire, either individual or group of billionaires like a professional sports team, or a large public company that can, presumably issue stock or issue debt to raise money relatively easily. I think it's probably still the case that the vast majority of borrowers can still give that certification and really shouldn't, lose a lot of sleep over it. But I think, that unfortunately that FAQ 31 that you're referring to, and then the SBA later issued another FAQ saying basically, so question 31, for anyone who's sort of read it on the Treasury's website, it gives the example specifically of a large public company with significant market value and says, we don't think that that type of a company is eligible for these loans. And then they added another question a couple of days later that said, well, what about a company that's owned by a private company that has, significant market value and access to liquidity? And the Treasury's answer was, well, see our answer above, essentially same answer. I think that's just causing, an awful lot of confusion. And like I said, there are sort of the egregious cases, but I think it's causing confusion even for borrowers who really should not worry too much about their ability to access this money and use this money.
All right. Yeah, I think it's going to be an issue because like you said, the statute said you don't have to, even though in most typical cases the SBA usually requires you before getting a loan from the SBA to look at other sources, and that is typically a requirement for other SBA loans. But I think we're just gonna. I think with what's going to happen is that it's going to get dicey. I'll be honest with you when I tell you I think it's going to get dicey, and I'm not sure if anybody can really foresee where it's going to go. I think the larger the amount of the loan the business is taking, I think the larger the percentage possibility of those companies or the lender is taking is going to really, kind of come back to this issue. And I think we're going to see more of those issues start to pop up when more investigations happen, but I could see more investigating trying to happen when the loan forgiveness is requested. That's when I really think there might be more issues popping up, is when people start trying to get, basically turning it into free money as opposed to an actual loan in the general context that we think of a loan. So trying to remember where we stopped. So recent SBA guidance has created uncertainty about whether businesses can access to cash or lines of credit can give the required service. So we're through that. And then
that's what we talked about. And then it's just the safe harbor, which is that basically if you represent a business that you think, might fall into this bucket, and obviously, I think maybe implicit in all that we're saying is, maybe this can be challenged, but it probably will be challenged. But if you don't necessarily want to pick that fight, or you think that you'd be better served by just returning the money, you do have until May 7. The SBA has created something of a safe harbor and said, look, if you return your loan funds by May 7, we will presume that you gave the certification in good faith, and we will not go after you for civil or criminal penalties.
Yes. So maximum loan amount. And we'll probably hopefully jump through some of this a little quicker now. Average monthly payroll based upon previous year multiplied by 2.5%, plus any outstanding amounts.
2.5%.
I'm sorry, 2.5%, 2.5 plus the outstanding amount of the economic injury disaster loan, the EIDL loans that have been made between January 31st and April 3rd of 2020 for a similar purpose. And most of us have heard of these EIDL loans, and with regards to most of them, most people have applied, whereas the rules came out saying you could get $10,000 basically without as emergency funds for pre-approval without any penalties and any need to really pay that money back. And I know most people did apply for that. However, then further guidance came out from the SBA stating that they were going to limit it to $1,000 per, up to the $10,000 per the number of employees that a business stated they had when they applied. So if not in business from February 15th, 2019 through June 30th, 2019, the amount's going to be determined using an average monthly payroll of January 1 through February 29th, 2020, multiplied by the 2.5. Plus the outstanding amount of EIDL, once again, made between January 31 and April 3rd. For businesses that have seasonal workers, this is going to kind of be an amount determined by the SBA, and the max amount being $10 million. So lender information is, really any SBA approved lender could make the PPP loans. Additional lenders were being added by the SBA or Treasury Secretary. Considerations for lenders as the business in operation on February 15, 2020, had employees who were paid and did it pay independent contractors. Loan fees were being waived. Borrowers not required to represent that it cannot obtain credit elsewhere, which is something we just had a big discussion about. And these are two big things here, really, is no personal guarantee being required and no collateral required. Those are huge things, basically showing that, trying to push this through as quick as possible, on these loans, but number two, really taking a lot of risk out of this loan for any of these businesses making it and the owners of those businesses trying to make it. Allowable uses of the PPP loans and uses for eligible for forgiveness. So payroll cost, up to $100,000 prorated for the covered period, or $15,385 per employee is the max. Owner compensation replacement up to $15,385 per owner. And those are for the individuals we talked about who are self-employed. Payments of group health care benefits for paid sick leave, medical or family leave, and insurance payments. mortgage interest, and there's no prepayment of principal allowed. It could be paid for rent. And once again, when we talk about these issues, rent, utilities, interest on others' debts, this is only for this 8-week period. It's not as if you can go out and say, I'm going to prepay my rent for the next 6 months.
I know.
Oh, go ahead,
Rob, I know that we spoke before about some accounting firms were advising, I guess I'll call it strategies, to maybe bonus out employees that earn less and try to maximize the amount of forgiveness and call that a payroll cost. And, we were discussing whether that, would even be an acceptable practice when asking for the forgiveness with that amount of payroll, because looking at the certifications that you have to make and the scrutiny that's going to get, how could you justify all of a sudden during this 8-week time to ramp up or pre-bonus out certain employees, and just what does that really look like?
Yeah, and I think if businesses do that, I think that's going to be a big issue, because unless you have some type of number one, even if you show that, hey, we've always bonused people out during this period for the last 10 years, I think looking at it and saying, well, you shouldn't be using these funds for that type of bonus. There really hasn't been anything there. And if you start ramping up, but then go back to regular salaries afterwards, once again, I think all of those things are going to show some inappropriate intent on behalf of the borrower for that.
So on the flip side of the coin,
Rob and Noelle, I'm going to respectfully disagree with you a little bit on this. I think that actually, if the $15,385 does operate as a kind of a cap, and in this day and age, that is not. I mean, it's a decent salary for a limited period, but it's not an egregious or outrageous amount of money. You're not paying money to the owner so he can go buy a yacht. And I think if you part of the goal of this entire stimulus bill, even sort of beyond the PPP loans, is to put money in people's pockets to keep the economy functioning. And I think that if a business says, look, we bonused out a couple of $1,000s to some of our lower or lower paid or mid-wage range employees, I don't necessarily see that as something that's going to show abuse. I think if you're using the money to pay owners, that potentially could be abusive. But again, so long as it's within the 15,000 limit or the 2019 net income limit, to be even more specific, I don't necessarily see that being considered abusive.
Do you think guaranteed payments for partners should be covered?
I do, and in fact, I think it's fairly clear.
Too.
Although the guidance from the SBA that came out was sort of regrettably not very clear. They sort of say, there were a couple of sentences that said, well, because initially it was unclear, and the guidance basically said, well, look, individual partners in a partnership, they shouldn't be doing their own SBA loans. They need to apply with their partnership, and to the extent of $100,000 per partner per year, again, prorated for this 8-week period, that counts as a payroll cost. So I would go even further than guaranteed payments. I think all payments to partners who are active in the business. I think they used a sort of nonsensical phrase. I think the SBA used the phrase generally active partners, which, I think for tax or corporate practitioners would kind of scratch their heads at, because that's just not a defined term or a known term.
I think really what the SBA was trying to get with that is to say, I think any partner who is getting a distribution from the partnership more than anything, anybody who's really getting cash out of that, because like you said, we're not going to have, every single partner applying for their own individual loan. So yeah, I think whether it's just a general distribution that typically comes out of the partnership, or whether it's that or as a guaranteed payment, either way, I think that is definitely going to be covered under the PPP loan. There's no doubt in my mind on that one. I agree with. I think the increase, I think, could be a little bit more touchy, but we'll kind of wait and see what they do with that, because with here also we say the payroll cost must account for at least 75% of the use of the PPP loan proceeds. So the question is are any of these businesses also then trying to pump up the payments to their employees to come into compliance with the 75% requirement? I think that might be something else that they look at, and we may not really know some of this until we get to that point in time when the loan forgiveness is requested.
I think that's what the motivation will be to amping up the bonus payments or having the company pay a greater proportion of the health care benefits, because if it's a race, the 8-week period to reach and satisfy and spend the PPA loan amount and actually spend 75% on that payroll, you're going to find some companies that may be short, and they're not going to want to forego the loan forgiveness. So this is where I think the motivation comes in with reallocating the buckets of payroll costs.
No, I agree. And I think that's going to be one of those difficulties. And what it's going to come down to is is how much of this money is the government really, how much of it does it really want to get back with regards to that, and how much is it willing to forgive? And I think when you look at most businesses, the real question is what are their what's their payroll cost generally compared to their entire cost overall? So we'll have to wait and see.
What sort of blows my mind about... Oh, sorry.
What
I'm saying blows my mind.
Go ahead, Noelle.
Oh, I was just going to raise the fact that the actual the bank, the lenders, are going to be the ones reviewing, I guess, the loan forgiveness applications and making certifications about what the amount should be. So all of these considerations are going to be reviewed at that lender level.
Yeah, so it's one of those things we'll have to wait and see on to some degree, I believe. So let's talk a little bit more about the PPP loan forgiveness. Up to the entire amount of the loan principal, and I will state, we do see that questions are piling up. We're trying to get to some of them throughout the speech, and we will have time towards the end here to go through as many as we can get through. Up to the entire amount of the loan principal and accrued interest can be forgiven if the proceeds are used in the following manner. So the payroll cost to at least 75% of the cost used is for payroll costs. Covered mortgage interest, mortgage entered into prior to February 15th, 2020. Rent, once again, prior to that it's a lease entered into prior to February 15, 2020, and then utility payments for services that started prior to February 15, 2020. So all of this really focusing on ensuring that we have a period where it started prior to the whole shutdown due to the COVID-19. The amounts eligible for forgiveness are narrower than allowable uses of the proceeds. So, you're allowed to use them on certain things, but not everything can necessarily be forgiven. Borrowers cannot deduct, and this is new, which just came out from the IRS. I think I feel like 2 days ago, where we just got notice from the IRS that borrowers cannot deduct otherwise eligible expenses, the payroll, rent, utilities, interest, to the extent a borrower is
We're going to talk about this. Rob, we're going to talk about this one in just a second. I did just want to say, just very quickly, because I know we're trying to get through the material in time to answer questions, and there's a lot of really good ones. But one of the things I wanted to say as far as the forgiveness or the amounts eligible for forgiveness being narrower than allowable uses of proceeds, you can use loan proceeds, for example, for rent, mortgage interest, utilities, things like that. If you qualify for forgiveness, rather, it's somewhat more limited. It's only, mortgage interest on a mortgage entered into before February 15. Likewise, rent for a lease entered into before February 15. So maybe the most obvious example would be if you have a business that entered into a new lease for space in March, and it pays the lease or pays the rent rather using its PPP proceeds, completely fine, acceptable use of proceeds, but you're not going to get forgiveness of that.
Okay,
that's a great point.
So forgiveness amount also includes costs incurred and payments made during the 8-week period beginning on the loan origination date. So it's, you're getting the loan and then you'll have that 8-week period as to when that, based upon your loan origination date for the amounts that can be forgiven. Costs incurred or payments made outside the cover period are not eligible for forgiveness. So if you get to the end of that 8-week period and you still have any of that money left over for the loan and then you use those funds, that's not going to be eligible for forgiveness. So loan forgiveness and tax.
I was just going to say, I think I can take the next couple of slides in any event, but I just wanted to say, parenthetically, like that, I think people have been scratching their heads and still are about that costs incurred and payments made language. And I saw that there was a question about, what happens if you have a payroll period that sort of falls over, you get your loan on, say, day 5 and payroll is on day 10. Can you use your loan proceeds to pay all 10 days of accrued payroll? I think while it's not entirely clear, the most likely answer to that is no, you can only use it for the 5 days that fell within the covered period, which again begins on the day you got your loan. And it's because of that costs incurred and payments made language. One of the things that we've been recommending to clients, if you've got a payroll period that would otherwise fall just outside the end of the 8-week period, would be to go ahead and accelerate your payroll, run a 1-week payroll, let's say, instead of a 2-week. So this way, you can still get that payroll in and sort of maximize your amount. It's a little bit unconventional, but if you're coming up toward the end of the period and you haven't spent all the funds, it seems as good an option as any. So I'm going to talk next few slides, the thing that Robb alluded to earlier about the forgiveness provisions, and then this recent IRS pronouncement that I'm sure, I think has attracted a ton of attention regarding tax consequences of these loans. So under the CARES Act, any loan forgiveness that would otherwise be included in gross income is specifically excluded. So obviously this is an exception to the general rule that, cancellation of debt generally is included in gross income. Obviously there are exceptions to that, but that's the general rule. Here they say that doesn't apply at all. So if you have $1 million loan and your loan is forgiven, you don't have any cancellation of debt income at all. It's just free money. Except just a few days ago, there was a new IRS publication, Notice 2020-32, which says that essentially, to the extent that you use PPP loan proceeds to pay for what would otherwise be deductible expenses like payroll, mortgage interest, rent, utilities, etc., to the extent that PPP loan is forgiven, there is no deduction allowed. And the IRS kind of says that, well, while normally those are all, ordinary necessary expenses or deductible interest, that under Section 265, it disallows, an otherwise allowable deduction for the amount of a payment of eligible expenses to the extent resulting in loan forgiveness. Or here, really, they're saying, look, to the extent that you use tax-exempt income to then pay a deductible expense, you're getting a double benefit if you do that. And so the IRS position right now is that that is not allowable. I have seen, and I suspect, my fellow panelists and probably others who are listening have seen a lot of, controversy about this already. Several prominent members of the House and Senate have said that that's, not what they wanted to see, that they wanted businesses to be able to get the greatest possible benefit from this, and that, that we may shortly see new legislation or an amendment to this particular provision, perhaps, that says explicitly, these to the extent that these funds are used for otherwise deductible expenses, they are deductible. So, are there? I don't know if did people have any other. I think Noelle, you and I talked a bit earlier. I don't know whether you had a comments about that, or I think you had some thoughts on that provision as well, as to whether or not this was likely to survive.
Why don't we go ahead and start moving forward then?
Yeah, let's move forward.
With reductions to headcounts and salaries. Yeah. Jonathan, I believe you're going to take that? Jonathan, if you're on mute, you might want to unmute. All right, I'm going to...
I'm happy to take this. Can you, or Rob, are you able to hear me?
Who is this?
This is Ivan.
Yeah, I hear you, Ivan. Yeah. Go ahead.
Okay. Yeah. Apologies. I think a couple of people are having some technical difficulties, so hopefully they'll be able to participate again shortly. So I'm just going to talk about reductions in headcount and salary. So there's this concept in the loan forgiveness provision, which basically says your forgiveness amount is reduced to the extent that you've had certain reductions either in employee headcount or full-time equivalent employees, or else or in employee salaries. So it's a relatively straightforward fraction. Basically, what it says is the forgiveness amount is reduced by multiplying what it would otherwise be by your average number of full-time equivalent employees during the covered period, which again, that's the 8-week period that begins on the date you receive your loan. And then you divide that by one or the other of the following, and typically you would always choose whichever one of these is going to be less, but it's either your average number of full-time equivalent employees between February 15 and June 30 of last year, or between January 1 and February 29th of this year. And so, to take a relatively simple example, if your forgiveness amount was otherwise $1 million, and you had 90 full-time equivalent employees during the covered period, and you had 100 during the testing period, you would multiply that million by 90 over 100, and you would arrive at 900,000. Notice, however, that I think I have encountered a couple of clients who seem to have the impression that, well, as long as my FTE hasn't gone down, I qualify for full forgiveness. And that's not quite right, because you still have to actually spend the money during the 8-week period. And if in fact your full-time equivalent number of employees has been, if it's down, even if it's still equal to or greater than what it was, during the testing period, you still have to actually spend the money. And so if your employment has gone down, it may be difficult for you to pay out enough in wages. That, to some extent that gets into, what we were talking about earlier with, what can you do if you come to the end of the period and realize you haven't paid enough wages to get full forgiveness? Can you accelerate a payroll? Can you maybe make contributions to employees' health care or retirement, or maybe a special bonus or something like that? And then there's also this provision that talks about your forgiveness amount being reduced by the amount of any reduction in salary or wages paid to an employee. Generally, it says who earned less than $100,000 or less on an annual basis during each pay period in 2019, to the extent the reduction exceeds 25% of the total salary and wages paid to that person during the last full quarter. What's interesting about this is it seems, again, sort of in my personal opinion, but I suspect others would agree, it seems to be just a very clear error in the statute. By its terms, it's telling you to compare, has pay gone down more than 25% in an 8-week period relative to a 13-week period? And the answer to that, even if salaries have been kept exactly the same, is virtually always going to be yes. And so I think, this is one of those issues where we are anticipating guidance from the SBA that will, clean this up and most likely will tell us that it's, you must have reduced salaries more than 25% on a sort of a per day or per hour or on some sort of apples to apples basis. But I know of a number of, tax practitioners or just, attorneys or accountants who've looked at this and said, well, the terms of the statute are such that, we're not comfortable sort of, the statute, while it appears to be in error, that is clearly what it says. So, and I kind of alluded to this a moment ago that, consider an employee who earned exactly $100,000. So that employee would be a person subject to this test. If the person's earning more than that, you effectively don't have to worry about them. You can cut the salaries of employees earning more by more than 25% without issue, or at least without necessarily reducing your forgiveness amount. But if somebody earned, if that individual, they would have earned $25,000 during the first quarter, they would earn no more than $15,385 during the 8-week covered period. That is more than a 25% difference. On a per day basis, you're paying them the same amount, and yet seemingly that's going to lead to a reduction. It's also, so there's an exception to the exception, which says that your forgiveness amount is not reduced due to reductions in headcount or reductions in salary if they are, quote, eliminated by June 30 of this year. And, I have some questions about what it means for a reduction to be eliminated. For example, if you reduce someone's salary from, say, $80,000 to $55,000, does that mean you have to repay them the difference? Or does it just mean that on or before June 30, you have to say, okay, going forward, your salary is restored? I don't know that there's a clear answer to that right now. And likewise, they say that the difference in full-time equivalent employees has to be eliminated by June 30. And, the question is, as somebody pointed out to me, an accountant that I've worked with pointed out, FTE always has to be measured over a period. By definition, it has to be a period. So does that mean you look at the pay period, ending on or within June 30? Does it mean you look to the prior month, prior week? As of right now, I'd be interested if people have other views on it, but as of right now, I don't think there's a clear answer to that.
I think that it could be either period, January to February of 2020 or February 15th to June 30th. But you know what I think, what I wanted to add about that was when you go to rehire, you don't necessarily, to cure and remediate losing the full-time equivalent, have to hire back the same body. You can hire back others. New employees can be hired. It doesn't have to be the same one that was furloughed.
That's exactly right. For the FTE, it does not have to be the same people. You just have to maintain the same number of full-time equivalent employees. It does appear, though, that for the reduction in salary, that does seem to be applied on an employee-by-employee basis. And so, if you have reduced the salary of a particular employee by more than 25%, and hopefully at some point soon we'll have some guidance on what that means, but if you reduce the salary of that person by more than 25%, you have to eliminate that reduction, or you have to restore the salary of that person, of that particular person. It doesn't matter if, for example, your aggregate salaries have stayed the same, or even your aggregate salaries of employees who earn less than $100,000. It appears to be at least a particular employee test.
Okay. So now we'll talk about really maximizing the loan forgiveness and moving forward onto that. So it's really, you have to maintain your headcount and the salaries of the employees earning less than the $100,000 to the greatest extent possible. And that's, obviously based upon the, name of it, the Payroll Protection Program, the PPP. Clearly it's about protecting that payroll, keeping people off of unemployment and moving people and keeping the businesses to be making those payments. So it's really the idea of trying to keep as many employees as you can and as close to their original salaries as possible. Consider making mid-year contributions to employees' retirement plans. These payments are counted in addition to the employee limits. Ensure rent, mortgage, and interest and utilities incurred during the cover period are paid. Make sure that they're paid timely. You have that specified period, that 8-week period. So if you know that bill is coming out and you can pay it online, even for those who still receive paper bills, maybe if you haven't received it yet in the mail, check online to see what that's going to be so you can make sure the payment's been being sent in timely with regards to that. Consider accelerating payroll periods. Deposit PPP funds into a separate bank account. This is more of a documentation thing than anything. I think as most of us, and for those of us who have done types of tax litigation, and for those of us, I guess, who also represent just business clients, we always talk about not commingling funds. So this is a step of taking, instead of just, as we usually say, personal funds and business funds, but not commingling the PPP into a separate bank account, because it makes it a little bit easier. It's easier to identify how the funds were used. So it's going to be something that makes it more simpler as to identifying and to being able to document down the road. Ensure you keep all documents regarding the PPP funds and how they were used. Cancel checks, copies of receipts, copies of bills. Technically, everybody should be keeping these things anyhow, but it's going to be even more important. I've done enough recreations and audits to know that it's not fun, and it's going to be even worse because there's a smaller time frame with regards to these requests that have to be filed and documented here. Remember, at least 75% of the PPP funds shall be used for payroll. So trying to ensure most of it is put in there. Timely file federal and state payroll tax returns and state unemployment insurance filings. So once again, it's really about, knowing now that we know what we can use these funds for, and to ensure that we're able to document them.
Rob, this is Noelle. I know that it's not on the slides, but when we go and speak about, applying for the loan forgiveness on this particular slide, I believe that once a borrower seeks the forgiveness of the loan by submitting all the documentation and making this certification, that the lender has 60 days to assess and make this determination. So I feel like it's almost like a pre-audit. Like, you know, normally everyone has their books and records, but in this particular circumstance, you really got to come loaded and ready, and keeping that contemporaneous documentation, including the canceled checks, the payment receipts, proof of where the payments went, like what you said, and the mortgage obligations, and just having, you know, I'm old school. I'd have a binder with it all hole punched or putting it up in a cloud, but just the nicer it looks, tabs and organized, I would think would facilitate your loan forgiveness application to A, getting pushed through sooner, B, withstanding any scrutiny, and just proving your certification, being diligent about what you did with the funds, it is certainly a best practice.
No, I agree 100%. And I believe Ivan's going to talk about this application process. But, you know,
yeah,
it's like you said, it's any type of audit. You know, you don't want your clients. You know, we don't want to be mailing this to the SBA or better yet to the banks in a shoebox, sending them the documents that way.
Yeah. So, you know, we don't know yet what that application necessarily is going to look like. We have, obviously, you know, this is these next several slides are either directly from the statute or directly from SBA guidance. So this is sort of what we know to this point, and effectively it's that the borrower will have to submit an application. That application is going to have to include documentation verifying the number of FTE employees and their pay rates. It's going to require copies of both federal and state, you know, payroll and unemployment insurance filings and those types of things. Notice, of course, that, you know, you're not going to file a special payroll tax return just for the covered period, for example. So, you know, while the payroll tax filing is likely going to cover, you know, a quarter or perhaps a month, you're going to have, you know, you're still going to have to show that, you know, it related to payments during the covered period. You're going to have to provide potentially canceled checks or bank records showing that payments were made and as of when. Obviously, for non-payroll expenses, you'll need to show payment of mortgages, payment of utilities, et cetera. And then, of course, the borrower is going to have to certify that, of course, the documentation was true and correct, and that the amount was used for, you know, valid covered purposes, as well as, you know, what we've talked about a few different ways, that, you know, that certification that the loan request was necessary to support the ongoing operations of the borrower given the current economic uncertainty. And I think, you know, we talked a bit earlier about, you know, the sort of how that has, at least to some extent, been called into question as to what that might look like, and how closely the SBA is likely to, you know, scrutinize that. You know, we did learn recently that the SBA will be auditing any request for, or they will be auditing any loan of more than $2 million at the time the request for loan forgiveness is made, and anything under $2 million, you know, it still doesn't mean it won't be audited, but it could be. Loans over $2 million, the SBA says every single one will be audited. And then last, I just want to talk about, you know, so if you apply for forgiveness and for all of the reasons we talked about, you couldn't spend the entire amount of your PPP loan, what happens to the remaining balance? The remaining balance has to be repaid over 2 years. The interest rate is 1% for all borrowers. There's an automatic 6-month deferral, so that there's no payments of interest or principal due for 6 months from loan origination date. And then effectively borrowers will have 18 months once payments begin, within which to repay interest and principal. There is no prepayment penalty, So obviously, to the extent the borrower is able, you can repay early.
Okay.
Oh, I'm sorry. I think I neglected a couple of things. My apologies. I neglected this last slide. So once you submit your request for loan forgiveness, the lender generally will have 60 days within which to make a decision. While there's no deadline per se for borrowers to submit their application, I think obviously borrowers will want to know as soon as possible. They'll want to have certainty about the amount of forgiveness that's approved and any balance that they're going to have to repay and over what period of time and so forth. And so, I think sort of best practice certainly would be as quickly as possible after the covered period or perhaps after June 30, you would want to submit everything so that the bank can make a decision. And as I said earlier, if for any loan in excess of $2 million, you can be pretty certain that there will be an audit of the forgiveness amount.
All right, moving on to the employee retention credit.
Hi, this is Jonathan Zimmerman from Morgan Lewis. I'm going to address the retention credit and Social Security tax deferral pieces of the presentation. And these exist in a sort of a parallel universe from PPP. Employers that apply for and receive PPP loans are not eligible to claim the CARES Act retention credit, and employers that receive a PPP loan and have all or a portion of that loan forgiven are not eligible to defer Social Security tax for periods after they receive that notice of loan forgiveness. So these are separate provisions that are available by and large to employers that are not availing themselves of the PPP program. Although on the Social Security deferral, you'd be able to use that provision until you receive loan forgiveness under PPP. So we'll start with the retention credit, which very generally provides eligible employers with a refundable payroll tax credit equal to 50% of the qualified wages paid from March 13th of this year through December 31st of this year, up to a maximum credit of $5,000 per employee. So an employer that pays $10,000 of qualified wages to an employee would be eligible for the maximum $5,000 credit. In other words, to the extent the employer qualifies for the credit and pays qualified wages to an individual, the maximum credit is $5,000 per employee. There are three broad categories of questions that arise under the retention credit. The first question is, does the employer qualify? And that's the threshold question. If the answer to that is no, then the rest doesn't really matter. The second question is, which employees received qualified wages and how much? And then the third question is, what's the process mechanically for claiming this credit? And all three of these are somewhat complicated, so we've devoted a separate slide to each one. Turning to slide 36, there are two different independent ways an employer can qualify for the retention credit. So there's two tests, and you only have to meet one of the two. In addition, eligibility for the credit is determined on a quarterly basis. So A, it's possible to qualify for some quarters and not for others. And B, it's possible to qualify for different reasons in different quarters. In other words, you can pass one of the tests in the second quarter of this year, and then the other test potentially in the third and fourth quarters. The first way to qualify is for an employer to have its operations fully or partially suspended during the quarter by a governmental shutdown order. So certainly at this point, even in the first quarter, because we saw a lot of these shutdown orders kick in March, there are many employers that will meet and have met this test. Similarly, in the second quarter, there still are obviously a significant number of businesses that remain shut down. Whether those shutdowns continue into the third and fourth quarters is an open question at this point. but even based on a rolling shutdown, an employer would be able to qualify for the credit in subsequent quarters. For example, if case counts tick up again late summer, early fall, that may be a basis for satisfying this test later in the year as well. The second way to qualify for the retention credit is if the employer's gross receipts declined by more than 50% compared to the same quarter in 2019. So for example, you'd look at your second quarter gross receipts in 2020, you'd compare those to your second quarter gross receipts in 2019. If the decline is more than 50%, then you qualify for the retention credit based on the gross receipts test. Now, there's also a little bit of a tail effect to qualifying under the gross receipts test. For example, if an employer qualifies for the second quarter because gross receipts declined by more than 50%, the employer would automatically qualify for the third quarter as well, and would qualify for the fourth quarter unless gross receipts from the third quarter rebound to at least 80% of the 2019 level. So you can wind up in a situation where your gross receipts could rebound significantly, potentially in the fourth quarter, but you'd still be eligible for the retention credit for Q4 based on your performance in Q2 and Q3. Another key point here is that affiliated entities are treated as a single employer for purposes of the retention credit based on a 50% ownership threshold. So that means that for purposes of the shutdown test, if any affiliate is subject to a full or partial shutdown by government order, then the entire group qualifies for the retention credit. There's some nuance there because you can only claim the credit for wages paid to employees who are not working for one of these same reasons. So the fact that one affiliate can cause an entire affiliated group to qualify may not be that valuable depending on individual employee circumstances. But just because this eligible employer test is a gateway test, you can get through that gateway merely by having one affiliate experience a shutdown. Similarly, because of this affiliation rule, the gross receipts test also is applied in the aggregate to all affiliated entities. So you're not looking at an entity by entity level at the 50% test, you're looking group-wide, which may take some work, particularly for larger affiliated groups. And then we'd also note that government entities and employers receiving PPP loans are not eligible for the retention credit. Jumping to the next slide, on slide 37, we add some detail regarding the definition of qualified wages. So let's say we've already determined that an employer qualifies either based on a shutdown or based on a decline in gross receipts. What sorts of wages will qualify for the credit? And here the rules are different depending on whether the employer averaged more than 100 full-time employees in 2019 or whether the employer had on average 100 or fewer full-time employees in 2019. For this purpose, full-time employees are measured using the same rules that apply under the Affordable Care Act. So generally, folks who are working at least 30 hours per week. And again, because affiliated entities are treated as a single employer, you'd apply the 100 employee threshold to the group in the aggregate rather than on an entity-by-entity basis. That's an unfavorable rule for employers because the scope of the credit is narrower for employers that had more than 100 full-time employees in 2019 and broader for smaller employers. Qualified wages do not include wages used in the computation of sick leave or family leave credits under the Families First Coronavirus Response Act, so we can't double dip between those two programs. For employers that had 100 or fewer employees last year, qualified wages includes any wages, including health benefits, paid to any employee. So this is really broad. You can pay folks in the ordinary course for work that they're doing and still qualify for the credit. So any wages you're paying to anybody, really in any context, will qualify for the retention credit if you average 100 or fewer full-time employees last year. For employers that average more than 100 full-time employees, the credit is much narrower. Qualified wages are limited to wages paid to employees who are not providing services due to a shutdown or slowdown. And that gets a little tricky in some circumstances. We address some of those tricky scenarios at the bottom of this slide. So one question that we had a bunch was, let's say you have somebody who's only working 3 days a week, but you pay them 5 days a week. If you're under 100 employees, that's fine. You can claim the credit for the full amount, up to the $10,000 limit. But if you're above 100 employees, you can only claim the credit for the excess portion of work. So in that example, where the employee is getting 100% of wages for 60% of work, the excess 40% that reflects the time period in which the employee isn't working is what qualifies for the credit. The IRS has determined in FAQs issued last week that severance pay does not qualify for this credit. The idea is that retention means the individual is still an employee, so severance, which is paid typically to someone who is terminated, generally will not qualify for the credit. But there's often a fine line between severance and furlough or garden leave or other similar situations where somebody's on the books as an employee, and for example, they remain eligible for benefit plans, they continue to vest in equity awards, et cetera. They're otherwise treated as an employee. Wages they receive for periods in which they're not working may qualify for the credit. Another question that's come up a lot is whether health benefits qualify, particularly if there's no other wage payment beyond the continuation of health insurance. So let's say the employer furloughs its entire workforce but continues to pay for health insurance for everyone without paying additional wages. Can you claim the retention credit in that scenario? And this is a controversial point because the IRS answer, at least as of now, is no. Can't claim the credit unless there's some wage payment in addition to the health plan payment. And our understanding is that that was not Congress's intent. The intention was to provide the retention credit in this scenario where the employer is only paying for health benefits. And it sounds like some folks on the Hill are talking to the IRS about this, and there may be more to come on this particular issue. If there isn't a change to the IRS guidance, it's also possible that there would be a statutory fix. That, in other words, we could see a subsequent stimulus bill that clarifies that payment of health insurance to furloughed employees without any additional wage payment will qualify for the retention credit. So stay tuned. This is an important question. And then the last topic we'll address on the retention credit is the process for claiming it. There are several ways to do this. The most common and quickest is to simply retain employment taxes the employer otherwise would remit to the IRS. So for example, when employers pay their workers, they withhold federal income tax, they withhold the employee share of Social Security and Medicare tax, they pay the employer share of Social Security and Medicare tax. When an employer qualifies for the retention credit, the employer can simply not remit a corresponding amount of all those other taxes to the IRS. And we're not talking only about taxes due on payments qualifying for the retention credit. The employer can hold on to taxes that otherwise would remit with respect to all wages it's paying to all employees up to the amount of the retention credit. So mechanically, it's pretty easy to access the funds generated by this credit pretty quickly. Another way to claim the credit, particularly if withholding taxes aren't sufficient to claim the full amount, is to apply for an expedited advance from the IRS using Form 7200. A third option is to wait until the end of the quarter and claim the credit on your quarterly Form 941 payroll tax return. And then the final, most conservative option is to pay employment taxes initially and then subsequently file a refund claim with the IRS. That may be a desirable option if you have some significant questions as to whether the employer actually qualifies for the retention credit. So paying the taxes up front and then filing a refund would minimize penalty exposure. The retention credit can be claimed in addition to the deferral of Social Security taxes. And one very important point is that we recommend that any employer claiming this credit prepare contemporaneous documentation, memos, payroll documents, et cetera, explaining why they qualify and how they calculated the amount that's eligible for the credit. We've seen some very liberal interpretations of certain provisions by the IRS. There's been a very tax-friendly approach to interpreting some of these CARES Act rules, notwithstanding the health insurance point we discussed a minute ago. But 2-3 years from now, when everybody's getting audited on these topics, circumstances may be different, and the IRS may look askance at some employers claiming this retention credit, depending on the circumstances. If that happens, you'll be best positioned to deal with an audit if you have a contemporaneous file memo and other supporting documentation explaining why you felt you were entitled to this credit. And then finally, I'll spend just a minute or two on the payroll tax deferral because I want to leave time for questions. A separate provision of the CARES Act allows employers to delay payment of the employer share of Social Security taxes on wages for taxes due between March 27th of this year and January 1st of next year. So basically, to the extent that an employer owes employer-side Social Security tax on any wages, the employer can simply not make those payments to the IRS, hold on to them, and defer those payments with 50% paid by the end of 2021 and the other 50% paid by the end of 2022. It's essentially an interest-free loan from the government for which any employer will qualify unless the employer receives loan forgiveness under PPP. If that happens, then the employer is allowed to defer employer-side Social Security taxes that are due up until the loan forgiveness date, and even after receiving the notice of loan forgiveness, the employer can continue to defer those earlier taxes through the 2021 and 2022 payment dates. But once a PPP loan is forgiven, an employer is no longer allowed to defer additional Social Security taxes that are due on later dates. And with that, I'll stop and leave some time for questions.
Thank you, Jonathan. We're now ready to begin taking questions from our live audience. Please use the question and answer feature on your webinar interface to submit questions. In fact, we have lots and lots of questions already, so I'm going to ask our speakers some of the questions that we have received. We'll try to get through as many as we can. The first question is, what is the start date of the 8-week period? Is it the date when the loan proceeds are received or the date the application is approved?
This is thankfully a very simple answer. It's the date you get the money. So the day that money hits your account is the first day of the 8-week period.
Okay, so the date the amount is deposited in the borrower's bank account. The next question has to do with bonuses. What if you pay a bonus for a worker showing up for work during a difficult time like we're in right now when there's a health risk? Would that be eligible for treatment as payroll costs?
And I think this is kind of something that we were all having our discussion about, where I do believe it is going to be eligible because you're kind of paying that premium by putting a worker into that difficult situation and into the health risk. But even if we were giving premiums or bonuses during this time, I think some of us believe, and others may not, that these funds still are going to be eligible for the deduction and count towards the payroll cost.
And I think maybe you could have an argument about whether or not it's truly a cost incurred, but to me, given the overarching purpose of the statute to keep people employed and to get money into the pockets of workers, I would think that's going to be fine.
When it comes to self-employed owners, that's what the next question is about. Can you consider and include health care costs in that $15,385 amount per employee owner? And
I am not I'm not 100% sure of the answer, but I can tell you this. I know that there is an answer to that, and I believe, but I would encourage listeners to double check the SBA guidance. I know that they have addressed that question. I'm about 70% sure that the SBA's response to that was that you can include only compensation and not benefits paid to owners. But so I mean, I guess the good news is I would say I know there's an answer to that, and I would just encourage the listener or the person who submitted that question to go to the Treasury's website, and I know that there is guidance that directly addresses that question.
Okay, thank you. Another question about self-rentals. If you have two companies that are under common ownership, Company A is the operating business and leases the buildings from Company B, which is the real estate holding company. Do the rent payments made by Company A to Company B qualify as payments on a covered rent obligation?
I could take that one. As long as there was a valid lease that existed before, February 15th, and it wasn't just created now, there doesn't appear to be a disqualification of a rent if it was due to common ownership or any kind of family attribution.
Makes sense. Another question. How would outstanding loans under this program, under the PPP program, be handled in the context of M&A transactions? Do we have any thoughts on that? In other words, would they be treated as liabilities, as genuine debt?
I don't see why they would be treated. I don't see why they would be treated any differently from any other liability. Presumably.
Yeah, I think it's
presumably. If the business was purchased, after the loan was received, but before the business had applied for forgiveness, then, depending upon how the actual purchase transaction was structured, the new owner would probably or might, then sort of inherit or step into the shoes and have the right to seek forgiveness. The only thing that is sort of that I wonder about that, and what makes that such an interesting question, is if you have a business that, let's say, is able to sell shares or sell interests or units close in time to when it receives one of these loans, does that create a problem with the SBA in the sense that they might say, but wait a second, you had other access to liquidity and capital?
Mm-hmm. Thank you. Thank you, Ivan. Another question, it has to do with paying employees to stay home. Would that qualify as payroll costs?
It certainly would. My only question about that is, to be clear, I mean, you don't necessarily have to be paying the employees to perform services. And in certain businesses that are shut down right now, you might well be paying them to do nothing or to do very little. I would defer to Jonathan, though. I'd be interested for his response to that, because there is a sort of, to the extent that you're paying employees who are staying home for certain purposes and those payments are qualifying for the employment tax credits, you cannot also benefit under the PPP provisions.
No, it's really the other way around. You can go ahead and apply for PPP however you like. It's just that if you receive a loan from the PPP, you're unable to claim the retention credit. So it's the PPP that drives this, and then the retention credit eligibility follows from whatever's happening on the PPP side.
Yeah, and with regards to paying employees, the entire idea really behind the PPP is to pay the employee. It doesn't necessarily require that employee to be working. It's really this idea of, just getting them paid instead of having those individuals filing for unemployment. and getting paid that way. So, I mean, one way or another, really the idea behind this is to ensure that the employees are paid, getting a salary, getting money, so that it's stimulating the economy, not necessarily saying they have to be, not necessarily that the business is open and working.
So we've received a number of questions on Notice 2020-32. One question in particular is asking whether there are any taxpayers considering challenging this position, and what is the likelihood that Congress will overrule the IRS?
There's been a lot of discussions with regards to that, and I can tell you I personally have heard from other individuals that Congress will be has already taken this into consideration and is probably looking at coming back to say that the deductions the service said are not allowed will be allowed. However, once again, that's just something that is flowing in the pipeline that we've heard out there. But, will taxpayers challenge it? I'm sure some taxpayers may challenge it. One of the things we were discussing earlier that Noelle had brought up is whether or not somebody in good conscience could still kind of take those deductions with that argument as that you have the right still to those deductions.
Yes, and I was under the impression, and I would defend the taxpayer that did, because to me, denying the deduction sort of eradicates the policy behind the PPP to begin with. And I just feel that if the CARES Act expressly allowed, no COD income, why didn't they had to have thought about this issue? And because it's not expressly disallowing the deduction in the statute, I feel like it's a fair position to take, and I would defend it.
Thank you. One final question. We've received some questions asking about deferred compensation, and this question in particular is asking whether proceeds can be used to fund non-qualified deferred compensation plans.
I don't know the answer to that, but I'm inclined to say, my inclination is no, and I'm sort of thinking through this out loud, and I'd be interested in what other people say. But it seems to me that it's the whole purpose of this is to put money into people's pockets in a pretty urgent way. During this 8-week period. Now you can include health insurance premiums paid during the period and allocable to the period, and you can include employers' contributions to retirement, again, provided they're made during the period and funded during the period. Things like deferred comp, I frankly think fall outside the purpose of the statute. I may be wrong. I don't know that I necessarily have seen any authority on that, but be interested to hear other people's take on it.
I agree with you, Ivan. I don't think that, it's not one of those things obviously listed within the statute. I have a feeling it's probably going to be one of those things that falls outside of the statute, kind of also looking at the purpose of what the whole PPP program is about.
Thank you. So many thanks to our speakers for taking time out of your day today to present on this topic. For our audience, that's all we have for today. But before we leave, I want to ask the all attendees who would like to receive COE credit, please stay connected for instructions for your COE certificate. There's going to be a program evaluation that will pop up on your screen after the end of the program. We'll be very grateful if you would take the time to complete that. In fact, you need to complete the evaluation to access the attendance confirmation. Allie, Petrova, thank you all for joining us. Please stay safe. I'll turn this over to the operator now for additional useful information. Thank you so much.
Thank you. On behalf of the American Bar Association and the ABA section of taxation, thank you for participating in this program. To learn more about the sponsors, Visit the ABA website at www.americanbar.org. Thank you, and please click on the evaluation link. We value your feedback.